In the early 2000s, the United States found itself in the throes of an unprecedented housing boom. Homes were being bought and sold at an astonishing rate, with values skyrocketing month after month. The allure of homeownership was palpable, a dream that seemed within reach for millions of Americans. However, as the dust settled in the years that followed, it became painfully clear that this boom was built on a precarious foundation. The housing crisis that unfolded was not a singular event, but rather the culmination of a complex interplay of economic, social, and political factors that had been brewing for decades. Before continuing the video, please like and subscribe to this channel. At the heart of the crisis was the economic environment of the late 1990s and early 2000s. The dot-com bubble had burst, leaving many investors wary and looking for safer places to put their money. Real estate, with its promise of steady appreciation, became a prime target. Mortgage lending practices began to shift dramatically during this period. Lenders, eager to capitalize on the growing demand for housing, lowered their standards. Subprime mortgages became increasingly popular, allowing individuals with poor credit histories or unstable incomes to qualify for home loans. This was a significant departure from traditional lending practices that had required borrowers to demonstrate a reliable ability to repay loans. The financial sector's innovation played a crucial role in the crisis. Mortgage-backed securities, MBS, emerged as a new investment vehicle, allowing banks to bundle thousands of individual mortgages and sell them to investors. This process was initially seen as a way to spread risk. However, it also created a disconnect between lenders and borrowers. Once a loan was made, lenders had little incentive to ensure that borrowers could repay it. The risk was transferred to investors, many of whom were unaware of the underlying quality of the loans they were purchasing. This lack of accountability led to a proliferation of risky lending practices, with lenders often approving loans without proper verification of income or assets. Social factors also contributed significantly to the crisis. The American dream, which had long been synonymous with homeownership, became an obsession for many families. The belief that owning a home was not just a goal, but a right led to a culture of overextending financially. Many individuals and families, driven by the desire to own property, took out loans that far exceeded their means. Real estate agents and lenders often encouraged this behavior, promoting the idea that home values would continue to rise indefinitely. The notion of flipping houses, buying properties to sell them quickly for profit, became a widespread practice, further inflating the housing market. As the housing market heated up, the political landscape also played a pivotal role. Policymakers, motivated by a desire to increase homeownership rates, enacted legislation that encouraged lending to lower-income families. The Community Reinvestment Act, for instance, aimed to ensure that banks served the needs of the communities in which they operated, particularly in low-income areas. While the intentions behind such policies were noble, they inadvertently contributed to the proliferation of subprime lending. Regulatory bodies failed to monitor and rein in the excesses of the financial industry, allowing risky practices to flourish unchecked. The government-sponsored enterprises, Fannie Mae and Freddie Mac, also played a critical role in the crisis. Created to promote homeownership, these entities bought mortgages from lenders, providing them with liquidity to issue more loans. However, as they sought to increase their market share, they lowered their underwriting standards, further fueling the subprime mortgage market. The implicit government backing of these entities led to a false sense of security among investors who believed that the government would step in to prevent a collapse, thus encouraging even more risky lending. As the housing market continued to expand, warning signs began to emerge. By 2006, home prices had reached unsustainable levels, and the number of foreclosures began to rise. Many borrowers, unable to keep up with their mortgage payments, found themselves in dire straits. Adjustable-rate mortgages, which had been marketed as affordable options, began to reset at higher interest rates, leading to increased monthly payments that many could not afford. The illusion of wealth created by rising home values crumbled, and the reality of financial strain set in. The tipping point came in 2007 when mortgage defaults surged. Financial institutions, heavily invested in mortgage-backed securities, began to suffer significant losses. The interconnectedness of the financial system meant that the crisis quickly spread beyond the housing market. Major banks and investment firms faced insolvency, leading to a domino effect that threatened the entire financial system. The collapse of Lehman Brothers in September 2008 marked a watershed moment, triggering a global financial crisis that reverberated across economies worldwide. The impact of the housing crisis was profound and far-reaching. Homeowners found themselves trapped in homes that were worth far less than their mortgages, leading to a wave of foreclosures that devastated communities. Neighborhoods that had once been vibrant and thriving became ghost towns, with abandoned properties dotting the landscape. The loss of home equity also wiped out the savings of many families, forcing them to reassess their financial futures. The American dream seemed to slip away from millions, replaced by a harsh reality of economic instability. The crisis also exposed deep-seated inequalities within American society. Low-income families, often targeted by predatory lending practices, were disproportionately affected. Many had been sold loans that they could never realistically repay, leading to a cycle of debt and despair. The fallout from the crisis widened the wealth gap, with affluent families often able to weather the storm, while those on the lower rungs of the economic ladder faced devastating losses. The racial disparities in homeownership rates, which had long persisted, were further exacerbated as minority communities bore the brunt of the crisis. Politically, the response to the crisis was equally complex. The government intervened with a series of bailouts and stimulus packages aimed at stabilizing the economy. The Troubled Asset Relief Program, TARP, was implemented to provide financial assistance to struggling banks, while the Federal Reserve slashed interest rates to stimulate borrowing and investment. While these measures were designed to prevent a complete economic collapse, they also sparked a contentious debate about the role of government in the economy. Critics argued that the bailouts rewarded irresponsible behavior and failed to address the systemic issues that had led to the crisis in the first place. In the aftermath of the crisis, the landscape of the housing market began to shift. Stricter regulations were introduced to curb the excesses of the past. The Dodd-Frank Wall Street Reform and Consumer Protection Act sought to increase oversight of the financial industry, aiming to protect consumers from predatory lending practices. Lenders were required to adhere to stricter underwriting standards, ensuring that borrowers could genuinely afford their loans. While these reforms were necessary, they also had unintended consequences, making it more challenging for first-time homebuyers to enter the market. The housing crisis also led to a cultural shift in attitudes toward homeownership. The belief that owning a home was an inalienable right began to wane. Many individuals and families reassessed their priorities, opting for rental properties, rather than pursuing the elusive dream of homeownership. The stigma surrounding renting diminished, and urban areas saw a rise in demand for rental housing as younger generations chose flexibility over the burdens of mortgage debt. As the years passed, the scars of the housing crisis began to heal, albeit slowly. The economy gradually recovered, and home values began to rise once again. However, the lessons learned from this tumultuous period remained etched in the collective memory of the nation. The crisis served as a stark reminder of the fragility of the financial system and the dangers of unchecked speculation and risk-taking. In the broader context, the U.S. housing crisis was not merely a financial disaster, but a reflection of deeper societal issues. It illuminated the vulnerabilities of the American dream and the disparities that exist within the housing market. The crisis underscored the importance of responsible lending, the need for regulatory oversight, and the responsibility of individuals to make informed financial decisions. As the nation moved forward, it carried with it the weight of these lessons, striving to build a housing market that was more equitable, sustainable, and resilient in the face of future challenges. The echoes of the past served as both a cautionary tale and a guide for creating a more stable future for generations to come. Subscribe to this channel to get useful information in the future.